Mortgage rates have been on a steady climb all throughout 2022. We started out the year at about 3.5% for a 30-year fixed mortgage rate, and we're now upwards of 6% for some scenarios. We're going to talk about what caused the major increase in mortgage rates because it's not the same thing that a lot of mainstream media tells you. We're going to talk about when we could see a decline in the mortgage rates. I was a mortgage banker for the past 3 years. I'm now making content on YouTube. I try to keep things as simple as possible. If you enjoy content like this, consider subscribing so this can reach more people and so you can learn more about topics on an easy to understand basis. So there's not much of a reason to expect for mortgage rates to fall in the near-term future. The National Association of Realtors chief economist Dr. Lawrence Yun says that he thinks rates will settle somewhere around 6.3 to 6.5% and could potentially even reach highs of 7%. Now, during the fourth quarter of 2021, Fannie Mae and Freddie Mac, which back a lot of the loans that are originated in the United States, were estimating at a time when rates were under 3% that we would reach somewhere between 3.5% and 4% in 2022 for the 30-year fixed mortgage. But we've now reached 6%. So why did they undershoot things so much? Well, a lot of people think that the 30-year fixed rate mortgage follows the U.S. 10-year Treasury, or some even think it follows the federal funds rate. But mortgages are actually packaged and sold as investments. So big investors ultimately end up buying these investments. Think of pension funds who need a consistent cash flow. So they buy mortgages, which ultimately get paid every single month, and they are able to take those returns and pay pension receivers their annual or monthly allotments. We also have hedge funds buying these investments as a risk diversifier. But in the past couple of years, the largest purchaser of mortgage-backed securities has been our own Federal Reserve. They were essentially buying mortgage-backed securities by the billions of dollars per month in order to entice banks to lend at low interest rates to pump the economy forward. So people were able to borrow a lot of money at really low interest rates, with the Federal Reserve saying we will step in and buy these mortgage-backed securities, and that will ultimately push a lot of money into the economy. Now, as we ran into a time of inflation, when we ran into all of the supply chain issues through the COVID-19 pandemic and all of the other things that have gone on since then with multiple shutdowns, and then of course the current war situation, it became clear that there was way too much demand as a result of billions of dollars per month being pumped into the economy at extremely low interest rates so that almost anybody could get a loan and be able to borrow hundreds of thousands of dollars. This ultimately pushed home prices up. It caused people to have to borrow more money, but they continued doing so because it was at a cheap rate. Well, now we're at a point where we're seeing inflation get to levels that the Federal Reserve is having to not only increase interest rates, but they also need to pull money back out of the economy by selling back all of the investments that they had previously purchased. So they've been buying U.S. Treasuries, and they've been buying the mortgage-backed securities. They're now holding about $9 trillion worth of assets between U.S. Treasuries and mortgage-backed securities, and they need to sell about $7 billion over the next 5 years. So now we've got a huge shift in supply and demand because there was a ton of demand for mortgages being artificially created by the Federal Reserve that now needs to sell these exact same investments. So they've essentially stopped buying, stopped creating demand, and they're flooding the market with supply. But because we have high inflation, and because it appears that the U.S. economy potentially could enter a recession, now we're at a point where investors are saying, I need a large return on my investment to take on all of this risk, because every month when I get paid, I'm getting paid a fixed amount from the mortgage that's originated, but every month it's worth less and less, now to the tune of over 8% according to the most recent CPI print. And when the economy slows down and people start losing their jobs, they're less likely to make their payments, which means defaults start to go up, late payments start to go up. We've also got the potential for housing prices, so the collateral for their investments potentially going down. Investors don't want to be underwater. They can't afford to have missed payments because, keep in mind, this is pension funds and they have a monthly obligation to their pension receivers every single month, whether they get paid from their investments or not. And every single month, it's being eaten up by inflation. So investors are saying we need a higher return. That ultimately means when the Federal Reserve is pushing these mortgage-backed securities back onto the market, they're having to increase the interest rates that ultimately they're pushing them back on the market for to entice anybody to buy them, because mortgages were being originated at under 3%. In fact, sometimes almost down to 2% on a 30-year mortgage. With inflation being at 7%, buying those investments would be a losing proposition from day one. In fact, many of the hedge funds that are ultimately buying these investments are still losing money on a real basis because they're still paying the Federal Reserve something like 5 to 5.5% to be able to receive 6% returns. But still, we've got the inflation, we've got the fact that there is some sort of default risk as well as prepayment risk. So when people refinance their mortgages or when they move, there's ultimately risk there because then the money gets pulled out of the funds from the investment that they've already made. So all of those risk factors need to yield a positive return, or else there simply won't be anybody to buy the mortgages that the Federal Reserve now has to offload. So mortgage rates do move loosely in tandem with the 10-year Treasury because the Treasury shifts with the economic outlook. When inflation's high, the Treasury goes up. That ultimately means that the mortgage rates need to go up to entice buyers, but it's not directly correlated. In fact, there can be times when mortgage rates go up faster than the 10-year Treasury or go down faster than the 10-year Treasury. Right now, there's really not a reason to believe that mortgage rates will go down because we're seeing the quickest level of increase in the past 50 years in mortgage rates due to the increasing risk of inflation, which has not yet been gotten under control, although there are some signs of it from some of the recent economic data that we've gotten. And there's also the prepayment risk, the default risk, and all the other risk factors are essentially at 40-year highs, which has caused the mortgage rates to increase more exponentially than anybody could have predicted at the beginning of the year when the economy looked like it was doing fine. So investors are ultimately going to need to wait to see, one, how higher mortgage rates impact their collateral, because remember, when they're buying these investments, the collateral is the houses. If somebody stops making their payments, they now become the owner of a house. But if that house value has gone down 50% and is now underwater because the borrower had put down 20 or 30%, now they have an issue just like we had back in 2008 with millions of potential houses that are upside down. The good news is there's more equity than ever before in homes, so there's much less risk of getting upside down investments, but funds still don't want to deal with it. They'd rather collect the money, everything be fine, make a positive return, and give that to their end investors. But they definitely don't want to take on the collateral. And so they're going to wait out for a while and see how mortgage rates impact housing prices, how inflation comes down, and how the economy does with how many people lose jobs and what sort of default risk that there is there. And ultimately, then we can start to see mortgage rates floating down. That probably also coincides with the time when the Federal Reserve decides what they're finally going to do in terms of inflation and what they're going to do with the federal funds rate. So again, we could end up seeing a decrease in the federal funds rate if the economy goes too far in the wrong direction, as it has appeared over the past couple of weeks that it potentially could. And that could ultimately cause the federal funds rate to fall, the 10-year Treasury to fall, and mortgage rates might not move exactly in tandem with that. We could have the 10-year Treasury fall off a cliff while mortgage rates continue to stay high because now there's exponentially more default risk if the Federal Reserve is coming out and saying that, hey, the economy looks bad and we need to pump the brakes. So overall, I think that we'll see actually a slower decline in mortgage rates. We need to wait for investors and the end buyers of these assets that are being pushed out on the market to decide what sort of risk that there ultimately is. Now, one thing that could send mortgage rates down even quicker than expected is if the Federal Reserve says we're actually going to not push these mortgage-backed securities onto the market and hold them in our own holdings as we have, where they've got the $9 trillion in the balance sheet between treasuries and mortgage-backed securities. And if they're not dumping them on the market and they don't need to entice buyers, then rates can actually fall back down because then banks can feel confident to ultimately lend money again at lower rates, knowing that they have a buyer that will still provide them a nice yield in the end. So it really depends ultimately on how the Federal Reserve moves, but the policies that they're making are not directly affecting mortgage rates. There are so many risk factors that go into mortgages, and ultimately I think it's going to be a long time before investors figure out what sort of risks are present to know what sort of yields they can pay. in order to shift the mortgage rates in any one direction. Let me know your thoughts down in the comments below. I love to get nerdy with this stuff. I hope that this makes some sense. I know it's not what's projected out in the media all the time. It's a little bit more in depth. So again, I hope this video brought you value. If it did, consider subscribing. Give it a thumbs up. A ton more content like this is coming down in the pipeline. Thanks so much. Catch you in the next one.